Hello and welcome to the Small Business Briefing. I'm Brian Kelly, the CEO of the Small Business Association of Michigan.
Hi, everyone. I'm Sarah Miller, Vice President of Marketing and Strategic Communications at SBAM. Welcome to today's show. We'd also like to take a moment to welcome our new VIP member, Threshold Performance Systems. Welcome owner Jason Borowitz and team located in Grand Haven. And of course, we're welcoming this new member on behalf of our sponsor, Marana Group, a data, document, and distribution company in Kalamazoo. All right, so let's talk about how the gubernatorial election is shaping up. What are the latest polls showing?
Yeah, this is, it's a pretty dynamic situation. So we saw the ticket on the Republican side come together over the weekend where Tudor-Dixon chose Shane Hernandez, a state representative from St. Clair County, to be her running mate. So that was approved by the Republican convention that was held in Lansing over the weekend. And so the ticket is off and running, if you will, is solidified, off and running. The ticket on the other side of the aisle, of course, with Gretchen Whitmer and Garland Gilchrist, both running for re-election. There has been a handful of polls that have come out recently, and from the incumbency side of things, Gretchen Whitmer's numbers have been pretty consistent at around 50 or 51% of the overall vote. On the for Tudor-Dixon and the Republican side, it's fluctuated in the public polls so far between a high of 46%, a low of 39%. And that might seem like a big range, but keep in mind that Tudor-Dixon is still kind of a new person on the scene. So the general election electorate is really just getting introduced. And so the fact that you have a kind of a wide range on that part of the polling is not particularly surprising. But just like we had talked about before, there's Michigan incumbency is a very powerful thing. Our state typically does elect governors to second terms. In this case, Gretchen Whitmer has a really big money advantage. And I would say probably that is the biggest vulnerability that Tudor-Dixon faces as she moves from the primary phase of the election to the general election. So not a position, at least as of now, that SBAM has taken any kind of position in. We've gotten involved in a lot of legislative races, have not looked at any of the statewide races yet, but this will prove to be one that obviously you'll hear a lot about over the next month and a half as we get closer and closer, 2 months as we get closer and closer to the first week in November when the election is held. So at this point, I would say that as the polling settles in, that Whitmer's numbers look pretty consistent across the polls, and Dixon's would show that the electorate is still getting to know her, and so that that range between 39 and 46% would be the idea that that's where she stands right now would really kind of fit the overall position and the point in the race where we're at.
And of course, if you're interested in viewing the candidates that we have endorsed, those can be found on our website for the House and Senate races. So Brian, we've covered the unemployment insurance agency fraud, across many shows, and they're still out there prosecuting criminals, which is good. So what have we learned from these efforts?
Yeah, thankfully there are still ongoing prosecutions, and we know that there'll never be recovery of all of the fraud and abuse that happened during the pandemic era when there was significant utilization of the unemployment insurance trust fund. But they are still going after in the U.S. District Court. A person by the name of Chaz Shields, 34 years old, pled guilty just last week to conspiracy to commit fraud and mail fraud, faces up to 20 years in prison when he gets sentenced. And he essentially stole through fraud the Paycheck Protection Program and Unemployment Insurance Agency. Those two programs had committed fraud and to the point of $2.2 million. So very, very significant for just an individual with some others that he was working with on false unemployment claims in order to actually 240 false unemployment insurance claims that he had kind of organized. Really, the sophistication of these crimes is something as they go through the process, you can see how far people went in order to steal that money. But thankfully, he'll spend time behind bars, and hopefully that will send a message to others who would ever consider doing something like that.
Absolutely. Let's talk about some news out of California, where a law was recently passed that will phase out the sale of gas-powered vehicles by 2035, which really isn't that far away.
Yeah, this was, even from California, the idea of setting a date at which point the sale of gasoline-powered vehicles would become illegal, kind of shocking. And so, I thought it made sense to bring this up or talk about this today, because it's there's a huge transition in the automotive industry. I don't know that there are many that would predict a point where gasoline would be vehicles would be phased out in that type of a time period, and yet California really pushing the envelope. And because that is the largest car market in the United States, more new vehicles purchased in that state than any other place, it's something that the industry will have to think about and adjust to. So, and where's the industry? Well, a lot of it's in Michigan. So this is when you consider this transition too, I want to make sure that for a state that is heavily dependent on the automotive industry as Michigan is, that just the number of components that are required for electric vehicles and the overall base infrastructure that we have today, there'll be a lot of natural displacement that happens already. The faster this transition away from the older style combustible engine happens, the more displacement there'll be in the automotive industry, and there's an outsized impact that has on people in Michigan. So when a lot of times there's many states that probably have the political dynamics where they could do what they did in California, but once a state goes first, it creates political pressure on those other states that have similar politics to move in similar fashion. So it's absolutely something that I think could have a big impact on the industry and anything that affects the industry, and how quickly the transition happens will have more of an impact in a state like Michigan than most other places.
Something certainly to keep an eye on closely. So Brian, did you see the White House tweets about Paycheck Protection Program loan recipients, kind of drawing comparison to student loan forgiveness? I think they came out last week and over the weekend.
Yeah, this was one. I was pretty disappointed. I mean, I understand the politics behind why they did it, and they were feeling pretty defensive about criticism that they had taken on student loan forgiveness. And while that's certainly not our issue, the idea of drawing a parallel to the Paycheck Protection Program and using it as a criticism is something that was really out of line. The Paycheck Protection Program was essentially utilizing businesses to provide relief to their employees who would have suffered the consequences of government imposed shutdowns. So, in other words, the government required in most places around the country for a period of time for people to be closed, like literally said it's illegal for you to operate your business right now. And their answer to that was to say you can get this Paycheck Protection Program loan, and if you spend it in a certain way, if most of it goes towards your employees, then you don't have to pay it back. And so to draw an equivalency or comparison between that, businesses who in good faith participated in a program so that their employees didn't get laid off as a result of government actions, to draw a parallel between that or to criticize essentially the Paycheck Protection Program shaming, which you've seen happen a few times over the last couple of years, was very, very disappointing. It's politics, and people in politics, both sides are attacking each other all the time. I just think it was unfortunate that they zeroed in on or used the Paycheck Protection Program, which was just the government trying to repair some of the damage that the government was causing, and throughout the process to business, but especially the employees of businesses that were forced, that otherwise would have been forced to be laid off through government actions. It's just disappointing, uncalled for. And so for everybody who did get a Paycheck Protection Program loan and later got it forgiven because you did give the money to the employees like you were supposed to, I would hope that there wouldn't be any kind of negative feelings about that, that it was the government's response in this case to create that program in order to take the edge off the ramifications of actions that were taken by the government to close down businesses. It was in a lot of ways it was the most successful of the programs that came out of the pandemic period of time, the relief programs. And I would hope that in the future they would look at that as a good example of how the government should take responsibility for problems that it itself creates.
All right, let's talk a little bit about China. Their GDP is still sluggish. They're still aiming for zero COVID. So what's the economic outlook like there? And then how does that impact us here in the US?
Yeah, there's been a lot of talk about the US's GDP being negative 2 quarters in a row. But if we look on the other side of the globe in China, which is the first or second largest economy, I think the fact that they're slowing down so much now has actually changed the dynamics between the United States and China. But they would normally look for their GDP to be around 5.5%, and so if you look, it's actually on pace this last quarter for about 0.4%. So not negative, but the way that China is structured, that if they're not growing, it creates a lot of risks for them. So that presents risks and opportunities for the U.S. The fact that China's not growing as fast is one thing, but also the whole economy is connected. And so if they fall into a recession, it will have global ramifications as well. So it's one of those I haven't seen it get a lot of attention yet, but it's one of those issues, one of those factors out there that would be kind of outside of the control of the of policymakers in the U.S. and yet could have a big impact on every economy in the world. But as you had alluded to, Sarah, they still are pursuing policies of achieving zero COVID, which I don't know of any other government in the world that is anywhere near that type of an approach. So a lot of their problems in terms of sluggish GDP and economic growth is really because they're closing things down still there, and trying to get to a point where it's zero. It's something that they had plenty of company 2 years ago and that type of a mindset, but I think they're the last in the world that are taking this type of an approach.
Yes, everyone is moving forward. Let's go back here to the US and talk a little bit about some economic issues. The Federal Reserve recently met. There's some new inflation rate figures, which it's going down, so that's the right direction there. But is there still talk about taking aggressive action and raising interest rates yet again?
I think what was kind of, sometimes like we've got this new reality, so some things seem kind of normal now, but they wouldn't have seemed normal before. And what really struck me about the the Federal Reserve meeting and the press conference afterwards, when the chair of the Federal Reserve was basically talking about the future rate increases, and that there would be likely multiple future increases. And the whole debate now is whether it will be 75 basis points each time or only 50 basis points or 0.5%. Now, in the past, 50 basis points is a lot. So to hear like, is it going to be only 0.5% or only 50 basis points it's strange. That would normally in and of itself be very aggressive action. And so it does beg the question, if inflation seemed like it was, had maybe turned a corner. It came out from in July at 6.3% as compared to July the previous year. So when you hear these, it's what are prices above the same month in the previous year. So we had a few months in a row here where it was over 8%, and that those were 40-year highs. Now 6.3% over July of the previous year. That is, so it might beg the question, why is the Federal Reserve still talking about aggressive monetary policy changes here in the future? And there's a few reasons for that. First is, it's not surprising that the rate came down because gas prices have come down, and that's a big piece of it. And so that was sky high before and has been steadily coming down over the course of the last couple of months. It was only a matter of time before it had an impact on the overall numbers. But the Federal Reserve would be looking at much more than that. So they would be looking at wage inflation and in terms of the overall cost structure within businesses, and there's still a lot of upward pressure there. There's also some risks when it comes to food and drought conditions, and so there's factors out there that there's a scale. Imagine I'm going to oversimplify it here, but the Federal Reserve looks at this scale. Is there a bigger, what poses the bigger risk right now? Is it inflation or recession? And if inflation is a bigger concern compared to recession, then they're gonna increase interest rates. One of the main levers that they can or knobs that they can turn. So that's what that's still the mode that they're in. We still expect there to be additional increases in interest rates, and the cost of borrowing will go up. And overall consumer spending, there's still some upward pressure on consumer spending, which again, only in inflationary times is that a threat. I mean, normally when inflation is running at the target 2%, then which by the way is their target. Federal Reserve wants inflation more like 2%. When it's running there, we see consumer spending up and some wages rise, like all that stuff in low inflation times is viewed favorably. In high inflation times, it means that the risk of inflation is higher than the risk of recession, and so we should expect them to continue. And we also saw some hints that the rates will go up at least a couple more times, and at 50 or 75 basis point increases, and then they're expected to stay there for a little while, maybe stay there through much of next year. That it's just too high to predict. But I felt like that Jerome Powell was the chair of the Federal Reserve Board of Directors was setting an expectation that they will continue to go up, and then they're going to stay up for a while, and until they're confident that inflation is under control. And we did, for the first time though, started hearing from some of the political people that are concerned that there'll be political ramifications from a recession. So if they are too aggressive and it puts the country into a recession that people feel more than just contracting GDP, but one that impacts overall wages and employment, then then naturally the political people are pretty concerned about what that means for their prospects as well. So normally this would be kind of kept out of the political world, but these days it seems like the political world gobbles up everything.
All right, well, I think this is a good segue into our Data Monday segment.
Yeah, let's take a look at some of the items. I tried to really keep in mind in terms of the items that we're going to talk about Data Monday today, to focus on the things that would maybe provide some insight into the sorts of things that the Federal Reserve, as they look to continue to slow down economic growth and demand. And this green box over here in the upper right corner, this is two things combined. It is the blue line are two things combined. It's both the GDP, the gross domestic product, which has declined, and gross domestic income. And you see, you put those together, they're not declining yet when they're combined. So GDP plus income is leveled off. It hasn't started going down. And now, what does that mean for the prospects of us having a more kind of traditional feeling recession? This is the last recession, which was very, very short during the early days of the pandemic. I think more instructional would be to look back at the this 2008-9 recession. It was a long one, but see how the GDP, even though the recession started here, the GDP plus income didn't start going down till here. And so what will often happen is GDP will move first, and then there's employment impacts on employment. So the fact that this is leveled off here, I do wonder if it's kind of showing this type of a precursor for something that feels more like a traditional recession. Looking at disposable personal income, you'll see that this is this got a little skinnier. So it's been positive generally growth in personal or disposable personal income, but getting skinnier again in inflationary times, not particularly surprising. This is something that the Federal Reserve would be looking at here, which is wages and salaries, and to see kind of that upward pressure still. So this is a lot of months in a row in growth above 0.5%, and so when you put it together annually, you see it could be very, very substantial. And then here's another one. It's from the Federal Reserve Bank of New York, and they do surveys, the lowest wage at which a person would be willing to change jobs. And it's a lot higher than it was before. So again, more signs that there's still upward wage pressure on out there in the marketplace, and definitely would be something that from an inflationary state, if your main concern is inflation, and the main cost input into a cost structure of practically everything is wages, then you would be concerned that we haven't seen the end of inflation. Now, looking at personal savings, they do this as a percentage of disposable personal income. Look how high it got during the days of the pandemic. You got a lot of extra money coming into households from the government, and also reduced expenses in many cases when things were closed down, and entertainment and travel and that sort of thing. So savings was really, really high, and not only now has it dropped down lower, but it's dropped down lower than pre-pandemic times. So coming in at 5%. So savings, U.S. savings has really plummeted, and now has fallen below where it had been for the previous decade prior to the pandemic. And then personal consumption expenditures. I thought this pretty interesting, because it does tell that supply chain and that shortage and an increased cost story, I think, pretty well. So you might look at this and say, well, look at the way that personal consumption increased right up until the point of the recession. And now look at the way that it's just on the same kind of trend line, even actually, at a little slower rate than before. Why is it that it's been so hard to fill that demand? And the first kind of most obvious thing is that supply chains don't just shut down and start right back up on a dime. I mean, these are well-oiled machines when they're going, but when different components are taken out, shut down, or not working right, it can make it very, very difficult. But to have entire industries kind of reprogram for this type of a drop and then have it to come back that quickly, this just makes, like, all of a sudden a bunch of demand that was not just there recently, and also that the market would be ill-equipped to respond that quickly to. And so I think a lot of the factors that we're feeling today are kind of a hangover from that. I thought this was kind of, it's a spaghetti chart on the top, but just look at the bottom where it's the average demand for all vehicles, and you'll see it's still going up. Now, it was interesting that this mid-range luxury SUV and mid-range sports cars are the ones that you see kind of up here at the highest. So again, another indication that demand and spending are still pretty high, and this kind of upward pressure overall on if it's holding up on big ticket items, then it good bet that it is on other things too. And then this one I thought I would throw in as kind of a bright spot, if you will, that things are kind of returning to normal in terms of the government's role in people's lives. So government transfer payments as a percentage of U.S. personal income. So of all the income out there, how much of it is coming to individuals from the government as compared to through the private sector? And so it's still higher than pre-pandemic levels, but it's normalizing. So it's getting closer to where we would want to see it. And then wanted to also point out that while it's not exceptional, our drought conditions now between severe, exceptional, and extreme drought, while this level of drought conditions across the country is not exceptional in the last 20 years, like there's been other times when we've seen it like this, this would be another constraint on potentially on our food supply when there's already been inflation in the costs. And so yeah, we saw this in 2012. We saw it in the first decade of this century as well. So it's not unique in that sense, but still one of those upward forces on the overall cost. And then we do see in the real estate market, some of the boom towns where people really moved to during the pandemic, or where there's like really hot real estate sales. And we have seen that there has been a bit of a drop. The homes for sale that have seen a price drop this year compared to last year is a lot more. So just an indication some of these really hot markets cooling off a little bit. And also the median days on the market. So when a house goes up for sale, it's now up to 23 days before it sells, and it was 17. So yes, that means it's cooled off a little, but I just want to point out that if you were to go back, pre-pandemic, so even let's go back to June 2018, the average was 40 days. So even though the real estate market is cooled off a little bit, still houses are moving, and they're moving a lot faster than they used to. So I would say overall, when you look at all of that information and you compare it to what the Federal Reserve is saying and doing, it kind of makes sense. You can see why they would want to they would want to still be aggressive with inflation containment when you have a few things starting to cool off a little bit, but still a lot of upward pressure on costs, and that will filter its way into prices and ultimately inflation. So Federal Reserve, I think, is looking at that same type of data and has come to the conclusion that it's going to be a little while yet before they can back off on these monetary policies.
All right, well, thanks for that Data Monday report. Before we say goodbye for today, I want to let everyone know that we have some events coming up next week. First of all, no show on Monday due to Labor Day, but we will be back here on September 8th. We'll be back to our normal Monday, Thursday schedule now that summer is winding down. But also on September 8th, we are partnering with Sensei on a webinar called Social Engineering, How Hackers Target Your Employees. So that would be a really great learning opportunity for you. We also have 2 upcoming owner-to-owner events. We'll be in Traverse City, September 8th, and Marquette on September 13th. So you can visit sbam.org/events for information on these and all the other events we have coming up. So have a wonderful week. We'll see you back here next Thursday, September 8th. In the meantime, if you need anything, please reach out.
Thanks, everybody. See you next time.